Learning Objective 10.3. Explain how Treasury stock affects a company. Treasury stock, as presented on the PowerPoint, Treasury stock is a company's own stock that it had issued and later reacquired. So the company sold it out to the open market. People were buying and selling it to one another. And then the company decided to go shopping and buy some stock, but not just any stock, its own stock, purchased it back from investors. Whenever a company does this, that stock that they purchase is considered to be treasury stock. Now, there are a number of reasons why a company might decide to do this. Reasons to buy treasury stock might include to offer it to employees as part of a stock program, maybe a retirement program where they're trying to make stock available to their employees. Well, to do that, they need to go out to the open market and purchase that stock. So they go out to the open market, purchase the stock, and then make it available to the employees through some type of investment program or employee stock program. This happens as well, but it's not as common. They may be looking to buy stock low with the understanding or with their knowledge that that price is going to be going up in the future for whatever reason. And what they're doing is almost investing in themselves, right? So they buy the stock low and then sell it at a higher price in the future. But technically, a company cannot invest in itself. So when they purchase it, they refer to it as treasury stock. They may do it to avoid a takeover if there's some inclination that many of the employees would be selling their stock and approve a takeover. If there's some inclination that many of the shareholders may approve a takeover, then they look to go and buy those shares back from the shareholders so that they can nullify those votes. By purchasing stock as well, they may be able to increase earnings per share. And that's the reason that works is if there's outstanding share, if there's less outstanding shares, then the earnings per outstanding share, which is EPS, will increase. They may have also a repurchase program where they're looking to return excess cash to shareholders. The question becomes, how is treasury stock recorded? And there are some rules associated. It's not complicated. It's just we just have to know these rules. Treasury stock, when it's purchased, is recorded at cost on the date of the purchase. We're going to disregard the par value, so that becomes irrelevant to us. And what we're going to do is we're going to create a contra stockholders equity account. And because it's a stockholders equity or equity section, normal balances for most accounts in the equity section are considered to be a credit. Well, this one is going to be carrying a debit balance. And any treasury stock that's repurchased will be reported beneath retained earnings on the balance sheet. So if you have a stockholders equity section, you'll see this is what you normally would see in the equity section. This is a bit simplified, but it still will give you a good gist of what's there. The first line here shows common stock. The next line is paid in capital, retained earnings. The next line is accumulated other comprehensive loss. And then below that, treasury stock. And then total stockholders equity. So it's not uncommon for treasury stock to be the last item on the list of the stockholders equity section. Okay, so let's take a look at how it's recorded. The following entry records the repurchase of 53 million shares for $7 billion. So the company decided to purchase 53 million shares back. In that purchase, we're going to debit treasury stock for $7 billion and credit cash. It costs $7 billion. So we're going to debit treasury stock, which is under the equity section. Normal balances under equity are usually credits, but in this case, it is a contra equity, so it will carry a debit balance of $7 million. And the company, in order to make that all happen, had to pay cash for it, right? So to pay cash is a credit to cash. That's also in 2016. Debit, credit. Now, after a company purchases the stock, the treasury stock, then they can do a couple of things with it. They can hold it forever, or they can sell it back in the open market, or they can retire it. The retirement of treasury stock cancels the stock certificates. I mean, we're just going to get rid of it. We don't want it after all. The retired stocks cannot be reissued anymore. Once repurchased, neither the total assets nor total liabilities are impacted or affected. And so the adjustment is simply a memorandum entry to decrease the number of shares issued in stockholders' equity. The resale of treasury stock is different. When a company buys the stock, they may decide in the future to turn around and resell it. Now, when that happens, they're going to be increasing assets and equity by the amount of cash received. So assets is going to go up because you're going to be receiving cash when they resell the treasury stock. But there's never going to be a gain or loss that's recorded as far as the sale of treasury stock, because it's their own stock, and ultimately, like we discussed before, they technically are not buying the stock as an investment. The amounts received in excess or short of original amount paid are recorded as paid in capital from treasury stock transactions. So let's take a look. We have a resale of treasury stock on July 22nd, 2016. Home Depot resold 1 million shares of treasury stock for $90 per share. Assuming that the average cost of the treasury shares is $70.15, the journal entry to record the resale of the treasury shares would have been as follows. So, well, first of all, how much did we sell it for? Well, they resold 1 million shares and they sold it for $90 per share. So that would be $90 million. So we know we're going to get some cash. It's going to increase cash. So it's $90 times the 1 million shares. And that is going to be a debit for $90 million. Now, when we repurchased it sometime before in the past, when we repurchased it, we bought it for the average, and this will be given, the average is $70.15. So now we have to remove the debit in the treasury stock account, and the debit we're going to be using is going to be for $70.15. So per share. So $70.15 per share times the same 1 million shares is going to give us a credit of $70,150,000. Now we're removing the treasury stock at what its original price was. And now we're left with a debit and a credit. Well, certainly we're out of balance. So we need to find a credit to drop into where? Well, the difference is $19,850,000. The difference is going to be categorized as paid in capital from treasury stock transactions, $19,850,000. So the way this is going to look on the T accounts, we took in some cash on 7/22, and we took in $90 million. We're going to go ahead and credit treasury stock because when it was originally purchased, the purchase is a debit, and we're getting rid of some of this debit because it's already been sold. So 7/22, the credit is $70,150,000. Now, based upon this transaction, we still have more treasury stock. There's still some there. So we're just taking out what we sold, and we take it out based upon the average price. And then finally, paid in capital from treasury stock transactions will be credited for the $19,850,000, and that as we discussed, is the difference between the debit and the credit. We're left with that credit. That's in alignment with the journal entry. In some cases, companies will issue stock for employee compensation. For example, Home Depot issued 4 million new, not Treasury, shares in conjunction with an employee stock compensation plan. The par value was 0.05, and the entry the company made was, well, they issued the stock. There was 4 million of them at a par value of 0.05. So we know that we're going to have to credit common stock for 4 million at 5 cents each. That total is 200,000. Now, whatever the fair market value is of those shares at the time, we're going to have to recognize that as compensation expense. So even though it's not listed here, the fair market value of the 4 million shares in total is $440 million. When we debit compensation expense for $440 million, we credit common stock for $200,000 based upon the par value. The difference then is going to be recognized as paid-in capital. And that difference is $439,800,000. So following along with this journal entry to demonstrate how the T accounts will be impacted, we have a debit to compensation expense of $440 million. So compensation expense is under the equity section, 440,123,123. So 440 million for the debit. There's going to be a credit to common stock of 200,000. The problem doesn't say what date it is, so I'll just use X. So there's our $440 million debit, our credit for 200,000. And then we need to debit or credit paid-in cap, and we need to credit paid-in capital for $439,800,000. That's also under equity, 439,800,123. And again, we don't know what date it is, so we just put X. So credit, and debit. All of it under the equity section. After transactions, which are going to be, we didn't account for every transaction that occurred, but after the transactions occurred, you could see now Treasury stock at cost, it'll show the 573 million shares. The next slide shows how the presentation of Treasury stock will be, assuming we still have 573 million shares of Treasury stock, and we'll show at cost, whatever the cost is. In this case, it's 40,194,000. Again, assuming that this is in thousands. So when we summarize Treasury stocks, when we buy Treasury stock, assets and equity will both decrease by the cost of the Treasury stock. When we resell Treasury stocks, assets and equity increase by the sales price of the Treasury stock sold, assets meaning the cash that's received, and Treasury stock is going to be credited, and that reduces the debit, so that's going to ultimately increase the equity section. Retiring Treasury stock to remove it from common stock and Treasury, there is just a memo entry generated. There's no real numbers. And then the issuing of stock for employee compensation, we're going to recognize expense in the year that occurs. We're going to issue out the capital stock. That's going to increase, and then additional paid-in capital is going to increase. All of these are all part of the equity section, so the overall equity will not be impacted, but items within the equity section will be impacted.